Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. As always, this is not investment advice. This is just how I personally analyze stocks and what I would do with them if I own them, or sometimes I do own them, when I might sell them, when I might hold them. And basically, I explain kind of my thinking and the process behind that. So we had got a request for Nextera Energy, which has fallen off of a cliff lately. And this is a really good one. I might even write on it at some point. But people really don't like kind of like I told you so articles. And I didn't actually tell anyone about this, but the members of my marketplace service, the Cyclical Investors Club, they definitely know how I've felt about utilities for a while now, that they've just been extremely overvalued. I have a whole theory behind it, with a lot of baby boomers retiring and bond yields being low, and I could go on and on about that. But this is an extreme example, but a good example of utilities, but it's also an excellent example of narratives versus numbers, right? So I always start, you'll notice that, and a lot of times I answer questions about stocks, like probably 1/3 of my day each day is spent just somebody asks me about something, I go and look at it. Well, the first thing I look at are the numbers, and specifically like a fast graph like the one that's up here right now. That kind of tells me a story, a basic story about the stock. And 90% of stocks I can eliminate from potential purchase just by looking at the historical earnings pattern. Now, that doesn't mean that I'm not going to miss out on some opportunities that were kind of, if a person did a lot deeper work, that they could kind of ferret out and figure out. But since I use an unconcentrated approach and I have to monitor a lot of stocks, I basically start with the numbers. I look for profiles of stocks that fit the type of profiles of businesses, really, that is the type of profile that has a good probability of producing better than average returns and adequate returns, and the type of returns that I'm looking for. So if something doesn't fit that profile, then it might be good, but it doesn't fit what I'm doing overall. Now, Nextera, actually, I do track. So at the right price, and then usually as these stocks get closer to the prices that I might actually buy them, then I do kind of deeper and deeper research, just looking for reasons why they might be trading that low that don't get captured in the basic numbers that show up. We've kind of seen that in the last two videos that I've made, where okay, something looks cheap, so you look at it and you say, okay, why does it look cheap? And then you kind of go through a checklist, and usually I can figure out why it's kind of cheap. And then if I make the necessary adjustments, often it doesn't look very cheap anymore. Sometimes it does, and then I end up buying them. But and sometimes they're just too hard for me to figure out, or they don't fit the type of strategies that I'm doing. Nextera really isn't one of those, as far as I can tell. Just to take you through my mindset when I look at something like this is what a utility earnings graph usually looks like. They're usually very steady. Usually you don't even have to adjust for share buybacks, because usually they don't buy back shares. Usually they're issuing shares, and that's captured in the earnings per share, which is what this dark green area is here. So that's pretty easy. The one more recent thing that I have adjusted for is debt, and that would definitely affect Nextera right now. But even when I wasn't, it was still very expensive. So when I first looked at this stock, well, we can just look at it on the fast graph, because it's not like super hard to figure this one out. We have, going back as far as the fast graph goes, it's had like 8% earnings per share growth. That's from like 20 years ago till now. And I think we'll look at it in just a little bit. My estimate for more recently is like 9-something%. So still right in target. So they have increased a little bit in this later period since 2015. And for utility, that's actually really good. Probably the only one I can think of off the top of my head that's that good is Berkshire's energy unit, which I think is also about 9% growth. So, usually utilities are like 6% or less or worse. It depends on how they manage their debt and everything else. But so high quality, I would probably buy this at the right price. But when I first started looking at it, I think I first put it in like my spreadsheet tracker around probably close to the peak here. And you can see it was trading in the 30s PE. It peaked out at like 36. And again, these aren't cyclical. There's like not really any adjustments like that you have to make. You can pretty much look at what the PE is, look at what the earnings growth has been. 2022, they had a pretty good growth year. I'll go ahead and shrink this down actually now that we've looked at this. So yeah, like 10%, sometimes poking into the teens, sometimes 8. But yeah, you're looking at, I mean, you can just look at it and see it's 9% growth. So unless you were expecting some huge growth thing to come along, which with the solar and stuff, I think a lot of people did, but you can just look at like how it's coming in. I mean, maybe they could surprise and start growing 20%, but the analysts don't expect that. And in this sell-off, I never even changed the earnings expectation. So this whole sell-off here, at least the last 6 months, I mean, we've been expecting that earnings, and it didn't change before the stock recently sold off. So people just had like really high expectations that, I mean, I don't get it because I don't pay attention to any of the stories that you hear. I just look at the numbers, and when I first put this in my spreadsheet to see how far it would have to fall before I would buy it, it was like 70 something percent. It was one of the most expensive stocks that I track. So these are just usually high quality stocks that I would actually consider buying. So at any given time, there's probably 300 of those that I actually have prices that I take the time to put like a price on. And these guys were in the top like 2% of most overvalued. And you have 9% growth and you have almost a 40 PE. You have quite a bit of debt. So like 65%, the total enterprise value is 65% more than the market cap. So when you take that into account too, I mean, it was just really expensive during this time. And it continuously, before we even got into like the COVID stuff, this part here from like 20, actually let's make this bigger. Since I'm ranting a little bit, but I mean, I think it's a worthy rant because I try to warn people about this, and it feels like nobody listens to me sometimes, but I know people actually do. But let's go just to like 2012. Okay, so we're out of the Great Recession. I'm not picking like a super bottom here. Like 2012-ish, you're looking at a 15 PE. During that time, again, if you add all these together, 8% growth probably if you average them out. So 8% at 15, that's like okay. You know, it's a pretty guaranteed 8%, right? It's not like you have to worry too much about earnings falling or not being able to keep up with inflation over time. So you get that. It's kind of like an inflation protected bond, which is another way to think about it. And what's the dividend? I don't know if they tell you that the yield was here. Okay, so the yield was 3%, 3.5% in a 0% environment or maybe a 1% environment. So you figure you're getting a couple percent, maybe even 3% above inflation, and then you can expect that to grow with inflation. That's not bad. Like, that's pretty good, actually, all things considered, at this time in 2012. But what happens from 2012, and we'll just run it up before COVID, before we get into like the COVID crazy stuff, we'll just run it up to like right before COVID. This is a 31 PE, right? So you get 220% growth a year and nearly triples, 276% return in, we'll call it 8 years. So, or 7 years. On a utility that's been growing at the same rate that it's been growing all along. And I think a lot of this is just, one, narrative hype and things like that, but two, it's investors chasing yield, like especially retirees and baby boomers who are going into retirement and they couldn't get bonds to pay them anything, basically. And they're looking, and back in 2012, that wasn't a bad deal. Like, that was a fair deal to get 3% inflation protected, 2.5 or 3% above inflation, and it's protected basically against inflation. That was a lot better. That was like 200% better than like most similar bonds. So it was a good deal here, but then people just like stopped paying attention to the valuation, and they started paying attention to, oh, this looks like it only goes up, or that, and they can go back here and say, oh, look at what let's just say it's not even at the peak. Let's say you're in 2018. You can say this has returned 14% a year, and it's safe. The retirees are looking for something that's safe, right? And so that just carries on, and then you get kind of the COVID hype to push it to the end, but it was just as bad before then, right? So that's kind of the story that goes behind it, that I think because there are other stocks like this. I mean, and we're starting to see it now with utilities. People are starting to get real about interest rates actually being high, or normal. They're just normal. That's the thing. If they were high and you thought, oh, well, the Fed's gonna pull interest rates back, that's one thing. But we're maybe a little bit above normal now, right? Especially on like mortgages, I think. But pretty normal for 3.6% unemployment, or 7 whatever. Basically a fully employed economy. To have interest rates where they are is very normal, or maybe low, which is why they could go up. I think we'll have a recession first, but I'm getting off topic here. So the valuation of this is pretty simple. Now we're down to 17. So the question is, is this a good deal? Short answer, no. Now it's valued about the same as the rest of the economy, right? So if you're familiar with kind of what I do here, this is kind of the rough estimate that you would maybe compare to like a 10-year treasury bond, which I think overnight hit 5%. So, and I think it pulled back down today, but it's basically right around this same return. But it won't go down. Well, if you hold it to maturity, like, you'll get your money, you'll get your 5%. You won't get the inflation protection. So the real question a person has to ask is, this will probably have some inflation protection, but the price can fall a lot still, as we've seen. And I'm assuming almost 10% growth. So right now, once you take into account the debt, which I think adds like a 60%, I think it's 67% more to what you actually think you're paying if you're buying the debt as well. Now, when I first started tracking this was in the 70s. It needed to fall more than 70% before I would buy it. Now we're looking at like 20. This is for the recession PE, which is taken off this low down here. So that's pretty low, but the normal buy price that's not recession based, that's just like where I would buy it, and that comes when this is 8%. So if the price fell far enough, where the basic earnings could produce like an 8% CAGR over 10 years, then that's when I usually look to buy. So that's almost the same price at like 28. Let's see here. So that's the basic, but I would note that if you're just looking to buy it at fair value, which the midpoint of fair value, this is actually not like 5% is the threshold I usually use for a sell. So it kind of got out of sell territory, at least. It's like a hold now, barely. But fair value I have at 37, which would be a 6.5% 10-year CAGR expectation. So I like to have a margin of safety before I buy. So these are going to be a little pretty low, but like 37 is what you're looking at for fair value, the midpoint of fair value, and it's at 51 now. So it still needs to fall. It's not cheap yet, I guess is what I'm sure that's what most people are wondering. Like, is it cheap now? Nope, it's priced about the same as the rest of the market, it's actually a little bit more expensive still, just roughly. The rest of the market's about 5.5 CAGR, and this is trading at a little bit more of a premium. Maybe some of that's warranted because the earnings are more stable. than the average stock in the market. But yeah, 37 is what we would be looking at. I'm not sure what else I can really say other than valuation matters. It can be a long time. I mean, here's probably the main thing. If I would have written an article, and I have stocks like this right now, and I'm looking at some of them to go visit. From 2019, I wrote a bunch of warnings. I didn't write one on this one, but let's just take the midpoint of 2019. If I was like, hey, this is overvalued, which it would have been with a 25 PE and 9% growth or something, probably would have been close to a sell, I would say. If I wrote something and 2 years later, a person is like, oh, well, you're a moron, it's up 75%. Well, it would have been true, but if you wait long enough with valuations for earnings and nothing changed here, this is all the same, and they didn't suddenly start earning more money, eventually, it matters. And now it matters right now. So now maybe if interest rates would have stayed at 0, it wouldn't have mattered. But when I do my analysis, even when we had 0% rates, I always just assume 3% long-term inflation. So when everybody else was like, you can go long duration, everything, all these banks with all their bad debt and everything else because they bought all these bonds, which is what's really been killed. And now just the bond proxies are also getting killed, which was absolutely 100% foreseeable, unless we had our immediate recession, inflation fell through the floor into deflation, and the Fed cut things to 0. That could actually still happen, but in that sense, you think, okay, well, if that happens, the stock market's going to crash too. So you should get an opportunity to buy something, hopefully. So that was my thinking all along. All right, yeah, if you want to join the Cyclical Investors Club Premium, I'll have a link down below. If you join Patreon, you can get a big discount on the other, on the main Cyclical Investors Club, and I'll have those links down below. If you have any other stocks you'd like me to look at, put a request in. I'll put it on my list, and whenever I get time, I will make a video. Thanks for watching. I'll see you guys in the next video.